Most traders believe success in trading comes from finding the perfect strategy, the perfect indicator, the perfect setup. But after enough time in the market, traders slowly realize something much deeper. The real battle in trading is psychological. Because even the best strategy can fail if emotions control your decisions. Fear can destroy discipline. Greed can destroy patience. Overconfidence can destroy risk management. And emotional mistakes can destroy months of hard work in a single day. That is why today, I want to talk about something extremely important: trading psychology and the 5 rules you must follow for long-term success. These are not complicated rules, but emotionally, they are difficult to follow consistently. And that is exactly why most traders struggle. If you stay with me until the end of this video, you will understand the core psychological rules behind profitable trading, how professional traders think differently, and how you can slowly build the mindset required for long-term consistency. And if you want to continue building a strong trading mindset, consider subscribing to Bull Mindset. This channel is focused on trading psychology, discipline, patience, and emotional control. Now let us begin with the first rule. Protect your mindset before protecting profits. This is one of the most important psychological lessons in trading. Most emotional traders focus only on making money, but professional traders focus first on protecting emotional stability. Because once emotions become unstable, discipline disappears. And once discipline disappears, consistency disappears too. Now let us go deeper. Imagine a trader who experiences 2 losses in a row. Immediately, frustration appears. Emotionally, they feel pressure to recover quickly, so they force another trade, then another. Then another. At the end of the day, emotional behavior caused more damage than the original losses. Now imagine a disciplined trader in the same situation. They also feel disappointment. But they pause. They slow down emotionally. They protect their mindset before protecting profits. This emotional stability creates long-term consistency. Now, let us move into the second rule. Think in probabilities, not certainty. This is one of the biggest mindset shifts profitable traders develop. Most emotional traders desperately want certainty. They want every trade to work. They want constant confirmation. And because of this, losses affect them emotionally. But professional traders understand something important. No trade is guaranteed. Losses are normal. Uncertainty is normal. Trading is based on probability, not perfection. Once traders emotionally accept this reality, pressure decreases significantly. Now let us go deeper. Imagine flipping a coin. Even if the odds are in your favor long-term, individual outcomes still vary. Trading works similarly. Good setups can lose. Bad setups can win temporarily. And once traders emotionally understand this, they stop reacting emotionally to every single trade. Now let us move into the third rule. Master patience before mastering profits. Most traders lose money because they cannot wait. They chase movement, force trades, trade out of boredom, trade because they feel emotional pressure to do something. But profitable traders understand something powerful. Patience protects capital. Patience prevents emotional mistakes. Patience creates higher quality decisions. Now let us talk about another important truth. The market rewards discipline more than excitement. This is difficult for emotional traders to accept, because emotionally, humans want action. The brain wants stimulation. But professional traders stay selective. They wait calmly. They avoid unnecessary trades. And this patience improves consistency. If this video is helping you understand trading psychology more deeply, consider subscribing to Bull Mindset, because mindset is what separates emotional traders from disciplined traders. Now let us move into the fourth rule. Never allow emotions to control risk. This is extremely important. Most blown accounts are not caused by strategy failure. They are caused by emotional risk management. After losses, traders increase risk emotionally. After wins, traders increase risk emotionally. During frustration, discipline disappears. And once emotional risk management appears, accounts become unstable quickly. Professional traders think differently. They understand something important. Controlled risk creates emotional stability. Large emotional risk creates panic, fear, impulsive behavior. This is why disciplined traders protect risk carefully. Now let us move into the fifth rule. Focus on process over profits. This psychological shift changes everything. Most emotional traders focus only on money, profits, results, winning. But professional traders focus more on execution, discipline, patience, risk management, emotional control. Because they understand good process creates long-term profitability. Now let us go deeper deeper into this idea. A trader can follow perfect discipline and still experience a losing trade. That does not mean the process failed. It simply means probability played out normally. But emotional traders judge themselves only by short-term outcomes. And because of this, emotions constantly affect confidence. Now let us talk about emotional stability. Emotional stability means staying balanced during both winning and losing periods. Not becoming too excited after wins. Not becoming emotionally destroyed after losses. This emotional balance creates better decisions. Now let us move into real trading examples. Imagine a trader who experiences a strong winning streak. Excitement appears. Confidence slowly becomes overconfidence. They increase risk emotionally, ignore rules, and eventually, emotional behavior destroys most of their profits. Now imagine another trader. They experience the same winning streak, but behavior stays stable. Same risk, same patience, same discipline. This emotional consistency creates long-term growth. Now let us consider another situation. A trader sees a strong market move. Fear of missing out appears immediately. Emotionally, they chase the trade late. The market reverses. Frustration appears. Now imagine a disciplined trader in the same situation. They see the same movement, but they stay calm. If the setup is missed, they accept it emotionally. They understand protecting discipline matters more than chasing opportunity. This is psychological maturity. Now let us talk about another important truth. The market constantly tests emotional weakness. If you are impatient, trading will expose it. If you struggle with discipline, trading will expose it. If you are emotionally reactive, trading will expose it. This is why trading becomes mentally exhausting for many people, because trading forces self-awareness. Now let us talk about self-awareness more deeply. Self-awareness means understanding your emotional patterns clearly, understanding what triggers fear, understanding what triggers greed, understanding what creates impulsive behavior, because awareness creates control. Most emotional traders react automatically. Professional traders observe themselves constantly. Now let us talk about routines. Routines reduce emotional randomness. Stable routines create stable behavior. Many profitable traders follow structured habits daily, review charts calmly, journal trades, review emotional mistakes, protect focus. These routines strengthen discipline over time. Now let us talk about journaling. Journaling is one of the most powerful psychological tools in trading, because journaling reveals emotional patterns. You begin noticing recurring mistakes, recurring emotional triggers, recurring impulsive behaviors. And this awareness slowly improves emotional control. Now let us talk about another important truth. Profitable trading often feels boring, and emotionally, many traders struggle with this. They secretly want excitement, constant action, adrenaline. But excitement usually creates impulsive behavior. Professional traders accept boredom, because boring trading is often disciplined trading. Now let us talk about emotional recovery. Every trader experiences difficult periods, losses, frustration, self-doubt. But professional traders recover differently. They do not carry emotional frustration into the next session. They pause, reflect, reset mentally. This emotional recovery protects consistency. Now let us move into practical exercises that strengthen trading psychology. The first exercise is emotional journaling. After every session, write down emotional reactions: fear, greed, frustration, impatience. This builds awareness. The second exercise is practicing pauses before trades. Before entering, ask yourself honestly, am I following my process or reacting emotionally? The third exercise is reducing emotional pressure through smaller risk. Smaller risk creates calmer decisions. The fourth exercise is reviewing losing trades calmly instead of emotionally. Look for lessons, not emotional self-destruction. The fifth exercise is tracking discipline instead of profits. Ask yourself daily, did I follow my rules? Did I stay patient? Did I control emotions? Now let us go even deeper. Most profitable traders became emotionally stronger through difficult experiences, through losses, through emotional mistakes, through frustration. These experiences forced growth, forced discipline, forced emotional maturity. This is how psychological strength develops over time. Now let us talk about confidence. Real confidence does not come from constant winning. It comes from trusting your process, trusting your discipline, trusting your emotional control. This creates stable confidence instead of emotional confidence. Now let us talk about emotional maturity. Emotional maturity means accepting uncertainty calmly, accepting losses calmly, accepting slow progress calmly. This emotional stability changes trading behavior completely. Now let us move toward the final message. Trading psychology is not a small part of trading. It is the foundation. Because your emotions control your behavior controls your consistency, and your consistency controls your long-term results. Let me leave you with one final thought. The market will always create emotional pressure, fear, greed, impatience, ego. These emotional challenges never fully disappear. But the traders who succeed long-term are the traders who learned how to manage themselves under pressure. They became calmer, more patient, more disciplined, more self-aware. And if you continue improving your mindset, your decisions improve. If your decisions improve, your consistency improves. And if your consistency improves, profitability becomes possible. And if you want to continue building that mindset, subscribe to Bull Mindset. I will see you in the next video. Thanks for watching.